Stop. Don't scroll. Don't skip. Don't turn up the volume while you do something else. Just stop. Because yesterday, Wednesday, March 4th, 2026, $530 million was ripped out of the Bitcoin market by force. Not lost, not withdrawn, ripped out. And every single person who had a short position open, every trader who bet that Bitcoin was going down, watched their account get executed automatically, violently, and without warning. $530 million. Liquidated. In under 12 hours. Now here's the part that nobody's explaining properly. That number is not the story. The story is what caused it. The mechanism underneath it. The structural move that made $530 million in forced liquidations not just possible, but inevitable. Because this was not random. This never is. And if you walk away from this video thinking, okay, Bitcoin went up, shorts got wrecked, moving on, you are going to be completely blind to what is being set up in this market right now. Today is Thursday, March 5th. Bitcoin is holding above $72,000 as you watch this. The bears are licking their wounds, and the mechanism that wrecked them yesterday is still running. I am going to show you the engine. Not the price, not the chart. The actual engine running underneath both of them. But before, I want you to hear our co-host Grace on this. Grace, the show is yours.
Thank you, John. Appreciate that. Okay, let me introduce you to someone. His name does not matter. What matters is what he was doing at 9:46 in the morning on Wednesday, March 4th, 2026, 60 seconds before everything went wrong. He managed a leveraged derivatives book at a mid-sized crypto fund. Institutional background, 6 years in the market. Bloomberg terminal open. Risk management framework in place. And sitting on one of the largest short positions he had built in months. Borrowed capital betting that Bitcoin would continue falling below $70,000. His thesis was logical. It was shared by most of the professional trading community. And it was built on 5 months of data that pointed in exactly one direction. For 5 consecutive months, Bitcoin had bled. From its peak of approximately $108,000 in late 2025, Bitcoin had fallen 41%. February alone saw funding rates drop to negative 6%, the most negative level in 3 months, as aggressive short positioning reached an extreme. The last time funding was this negative was February 6th, when Bitcoin bottomed near $60,000. Negative funding rates this deep mean short sellers are paying a daily premium to hold their positions. They are bleeding premium while they wait for the thesis to play out. Our trader had been bleeding for weeks, but the chart kept going down. The thesis kept feeling right. Bitcoin sat directly between 2 massive liquidation clusters. $254 million in short liquidations stacked above $70,000. $323 million in long liquidations stacked below $65,000. The setup was visible on any public data dashboard. A loaded gun with 2 triggers. If Bitcoin broke above $72,000, exchanges would automatically begin force closing short positions, which means automatically buying Bitcoin at market price, which pushes the price higher, which triggers the next cluster, which buys more Bitcoin, which pushes the price higher again. Every professional derivatives trader alive knows what that cascade looks like. They teach it in week 1 of any trading course worth taking. Our trader knew it was there. What he did not know was what was about to light the fuse. At 9:47 in the morning, a Reuters alert hit his terminal. 12 words. White House formally sends Kevin Warsh's nomination as Fed chair to Senate. His short position started moving in the wrong direction, then faster, then the cascade began. By end of day, $530 million in leveraged bets against Bitcoin had been forcibly closed. Bitcoin rallied as much as 8.9% to around $74,000, its highest level in a month. And our trader was staring at a screen trying to understand how a 12-word press release just ended his quarter. He was not stupid. He was watching the chart. The smart money was watching Washington. The difference between those 2 screens is the entire story of yesterday. And understanding it is worth considerably more than knowing the price. Thank you for the opportunity to join you, Podcast John. Your turn.
Thank you, Grace. It's great to have you on the show. And by the way, guys, do you want me to bring Grace to the show more times? Comment below. Okay, let me tell you the version of Kevin Warsh that the Bears read. 55 years old, former Federal Reserve governor from 2006 to 2011. Known for dissenting on stimulus measures during his Fed tenure, consistently emphasizing inflation risks even during periods of economic stress. Bloomberg's chief U.S. economist, Anna Wong, summarized it bluntly. If Trump wants someone easy on inflation, he got the wrong guy in Kevin Warsh. That is the biography, and it is accurate. Hawks keep rates high. High rates reduce liquidity, which is bad for risk assets like Bitcoin. So the bears built their thesis. Warsh equals tighter monetary conditions equals Bitcoin lower. Logical, internally consistent, and professionally constructed. And built entirely on the biography while ignoring the actual record. At the Hoover Institution's Inflation is a Choice event in July 2025, Warsh said this about Bitcoin. Bitcoin doesn't trouble me. He continued, I think of it as an important asset that can help inform policymakers when they're doing things right and wrong. It is not a substitute for the dollar, but it can be a very good policeman for policy. A policeman for policy. That is not the language of someone who wants to suppress Bitcoin. That is the language of someone who understands that Bitcoin rises when central banks are irresponsible with money, and respects what that signal measures. In a Bitcoin magazine post that circulated widely after the nomination, Warsh was quoted directly, if you're under 40, Bitcoin is your new gold. He said that at $30,000, before the ETFs, before the strategic Bitcoin reserve, and before institutional infrastructure existed at the scale it does today. In the past decade, Warsh has compared Bitcoin to gold on several occasions, describing it as a sustainable store of value, like gold. He has described crypto infrastructure as the newest and coolest software that will enable things previously impossible. His indirect crypto ties include early investments in the Basis stablecoin project and advisory roles with Bitwise, a crypto index manager. He is also a partner at Duquesne Family Office, working alongside Stanley Druckenmiller, one of the most respected macro investors alive. Strategies, Michael Saylor dubbed him the first Bitcoin-friendly chairman. This is the man the market spent 6 weeks treating as an enemy of Bitcoin. This is the man whose formal Senate nomination triggered the liquidation of $530 million in short positions in under 12 hours. The bears read the biography, but they missed the record. And that oversight, that specific, preventable, publicly available information gap, is what makes yesterday's move so instructive. Because the information that would have saved those $530 million was not hidden. It was in Bitcoin Magazine, and it was in public Hoover Institution event transcripts. It was in the quotes that Michael Saylor was posting on social media. The bears were not missing access to the data. They were looking at the wrong data. I'm going to show you something now that I believe is more important than the Warsh nomination, the short squeeze, and the $530 million liquidation number combined. On Wednesday, March 4th, 2026, Bitcoin rose 9%. On the same day, gold fell 3%. Bitcoin has outperformed traditional safe havens like gold in recent days, reversing the trend of recent months and signaling a potential regime change in how serious institutional capital thinks about Bitcoin's role in a macro portfolio. Let me be precise about why a 12 percentage point divergence in a single session matters so much. For 40 years, gold has been the default answer to one specific question. Where do you put capital when you do not trust the financial system? Inflation hot? Gold? Government printing excessively? Gold? Geopolitical uncertainty spiking? Gold? Central bank credibility collapsing? Gold. This is not theory. It is 4,000 years of documented financial behavior. Every central bank on earth holds gold as a reserve asset. It is the established, unquestioned answer. Bitcoin has been making the case that it deserves a seat at that table since 2009. The conventional establishment has resisted that argument consistently. Their counter-argument is coherent. Bitcoin is too volatile, too young, too speculative. Gold is 4,000 years old. Bitcoin is 15. The comparison is premature. And then on the same day, same Fed uncertainty, same geopolitical backdrop, same macro environment, gold fell 3% and Bitcoin rose 9%. That is not two assets responding differently to the same news. That is capital, actively moving from one asset to the other, in real time, in a single trading session. Last year, Bitcoin and gold were moving together, what analysts called the debasement trade, both hedges against a weakening dollar, both responding to the same monetary policy signal, and highly correlated. That correlation broke last week. Analysts are now saying that a shift in liquidity from gold to Bitcoin may be starting. If Bitcoin has already found its bottom while gold has peaked, markets could soon show Bitcoin breaking higher while gold weakens further. Here's the question. This divergence forces you to answer. What permanently changes the relationship between gold and Bitcoin? Not price action, not halving cycles, and not on-chain metrics. Washington. A Fed chair nominee who calls Bitcoin a good policeman for monetary policy. A senator who chairs the digital assets subcommittee saying banks will offer Bitcoin services alongside dollars. 2 federal banking regulators removing advance permission requirements for crypto engagement. And a U.S. strategic Bitcoin reserve already holding 328,372 Bitcoin, making the United States the largest known sovereign holder of Bitcoin in the world. The United States government holds more Bitcoin than any other government on Earth. When you see that institutional architecture, and then you see gold fall 3% on the same day Bitcoin hits 9, you are watching something specific happen. Capital migrating from the old infrastructure of monetary protection to the new one. The question is whether Wednesday was one session of divergence or the first session of a structural shift. Analysts note that Bitcoin still needs stronger confirmation. Historically, Bitcoin has often rallied when gold slows down, but Bitcoin still needs sustained outperformance across multiple trading sessions and macro data points, not just a single day, to confirm the regime change. The confirmation signal is the $74,000 daily close. More on that in Chapter 6. But first, let me show you what the most important money in this market was doing, while everyone else was calling it a bull trap. Here is a number that deserves to exist in silence for a moment before I explain it. $767 million. That is what BlackRock put into its Bitcoin ETF in a single trading day on Wednesday. $767 million. One asset manager, one day, while social media was screaming bull trap. While retail investors were debating whether to sell, the bears who had just been liquidated were trying to explain to their risk committees what happened. This marked the largest single-day inflow into BlackRock's Bitcoin ETF product in the past 5 months, underscoring renewed interest from institutional investors. Over a 3-day period around the Warsh nomination, combined inflows into spot Bitcoin ETFs exceeded $1.1 billion. The presence of industry giants like BlackRock and Fidelity in the ETF landscape lends credibility. When the world's largest asset manager offers a Bitcoin ETF, it signals that digital assets have crossed a legitimacy threshold. Institutional allocators require product infrastructure, custodial assurances, and regulatory clarity before committing capital, and the ETF framework satisfies those requirements. March's inflow surge suggests institutions are increasingly comfortable deploying capital through these vehicles. 0 outflows across all 12 U.S. spot Bitcoin ETFs on Wednesday. Not one fund posted a redemption, and 7 funds posted positive flows simultaneously. So Value data showed spot Bitcoin ETFs recorded $225 million in net inflows on March 5th, today as well. BlackRock's IBIT absorbed $322.4 million, which outweighed redemptions from rival products. The move followed $787 million of inflows during the previous week. That rebound ended a 5-week stretch during which funds saw nearly $4 billion in withdrawals, $4 billion in outflows over 5 weeks, daily headlines about institutional abandonment, and then $1.1 billion in 3 days. The $4 billion in outflows generated daily coverage. Institutions are leaving, the experiment is failing, crypto winter is here. What that coverage missed is that outflows from ETFs do not mean the capital disappeared. It means the capital repositioned into OTC purchases, futures positions, private credit structures, forms of exposure that do not appear in the daily ETF flow reports. The institutional thesis did not break during the 41% drawdown, it accumulated. And on Wednesday, it expressed itself simultaneously through ETF inflows, a short squeeze, a gold-Bitcoin divergence, and a political signal from the most powerful monetary and legislative offices in the United States. Sustained directional moves in Bitcoin increasingly correspond with ETF data, not speculative leverage. Volatility drivers are shifting from speculative leverage to institutional flow momentum. The people who built their shorts based on the outflow headlines were reading the surface. The people on the other side of those trades were reading the structure. Here is where most crypto coverage stops. Price went up, institutions bought, bull confirmed, see you next video. That is not what this channel does. There are 4 genuine risks attached to everything we have just covered. And they deserve the same serious treatment as the bull case. Because if you only hear the bull case and one of these risks materializes, you're going to make decisions based on incomplete information. Risk 1. Warsh's hawkish philosophy is real, and it cuts both ways. Warsh views Bitcoin as sophisticated software enabling new possibilities, not a fiat killer. His intellectual openness to Bitcoin's role meets hawkish policies that could crimp liquidity-driven rallies. This is a double-edged sword. The same man who calls Bitcoin the new gold also believes financial markets have become addicted to central bank liquidity, and plans to do something about that addiction. Bitcoin's greatest bull markets happened during maximum liquidity expansion. Warsh is on record opposing maximum liquidity expansion. Both of those facts are simultaneously true, but they point in different directions. Which version of Warsh shows up in office is the single most important unknown in this market over the next 12 months. Risk 2. The Senate confirmation is not guaranteed. Senator Tom Tillis, a Republican on the Senate Banking Committee, has publicly stated he will oppose confirming Warsh until a criminal investigation into Jerome Powell is resolved. Powell revealed that the Justice Department subpoenaed the Fed over his Senate testimony about the central bank's $2.5 billion building renovation project. If Tillis votes no alongside all Democrats on the committee, The nomination does not pass out of committee to the full Senate. The market priced in Warsh's confirmation on Wednesday as if it were certain. It is not certain, so watch the committee dynamics closely. Risk 3. The bull trap comparison is not wrong. It is just not proven yet. Arthur Hayes warned investors not to celebrate too soon. He noted Bitcoin still moves closely with U.S. tech stocks, and that the latest price jump could be a temporary rebound rather than a sustained rally. His analysis suggests Bitcoin has not yet broken away from the broader tech sector's trend. In January, Bitcoin surged from 65,000 to 98,000 on momentum, and then collapsed to 60,000 in 2 weeks. Wednesday's move at 9% is dramatically smaller than January's move. The structure of a bull trap does not require the same size. It requires the same sequence: brief breakout above resistance, euphoric response, reversal below the breakout level. That sequence has not been ruled out. Risk 4. The geopolitical backdrop remains genuinely dangerous. The U.S.-Iran conflict that began February 28th is unresolved. Bitcoin's behavior during that conflict was mixed. Initial crash, recovery, then Wednesday's rally. A significant escalation, Strait of Hormuz closure, direct infrastructure damage, expanded proxy warfare, creates a risk-off environment that even the strongest regulatory tailwinds cannot fully offset. These 4 risks are real. Anyone telling you they are not is not giving you the full picture. Today is March 5th. Bitcoin is holding above 72,000. The bears are rebuilding their models. And the question now is not what happened on Wednesday. It is what the next 72 hours tell you about whether Wednesday was the beginning of something structural or a very well-constructed head fake. Here are the 3 signals. Specific, observable, data-driven, not predictions, just signals. Signal 1, the $74,000 daily close. Bitcoin is approaching a critical price zone between roughly $73,750 and $74,400 that has repeatedly marked major turning points over the past 2 years. A daily close above that zone, held for 48 hours, would represent a successful retest of former resistance turning support. It would open an air pocket between there and $80,000 where on-chain data shows almost no supply overhead. Watch the daily close, not the intraday high or the social media screenshots at 2 in the morning. The daily close above 74,000, held for 48 hours, is the only technical confirmation that matters right now. If Bitcoin closes back below 72,000 on a daily basis, that is the first warning sign. It indicates that Wednesday was a positioning event, not a trend change. Signal 2, ETF flow continuity over 5 consecutive sessions. The recovery from the February lows came alongside a reversal of outflows from spot Bitcoin ETFs. Analysts noted the rally may be fragile without sustained spot demand as opposed to purely leverage-driven momentum. Watch daily ETF flow data from BlackRock's IBIT and the overall ETF complex. If institutional inflows sustain above $200 million per day for 5 consecutive trading sessions, that confirms the institutional accumulation thesis is a sustained trend, not a single session anomaly. If flows turn negative while price holds, leverage is driving this, and the foundation is fragile. Signal 3. The gold-Bitcoin relationship over the next 2 weeks. One session where gold falls and Bitcoin rises is an interesting data point. 2 weeks of that pattern across multiple macro data points is a structural signal. Analysts note Bitcoin needs stronger confirmation of a trend change, and the most reliable confirmation would come from sustained outperformance against gold across multiple trading sessions, not just a single day's divergence. Watch the gold-Bitcoin spread daily. If the divergence holds and widens, the capital migration thesis is real and durable. If gold recovers and Bitcoin falls back into correlation, Wednesday was noise, and the debasement trade is still one trade, not 2 separate ones. Those 3 signals will tell you more about this market over the next 2 weeks than any price target posted anywhere on the internet today. Let me bring you back to where we started. 9:46 in the morning on March 4th, a derivatives trader with a Bloomberg terminal and a 6-figure risk management salary, sitting on a perfectly constructed short position above $72,000. At 9:47, 12 words arrived. And by the end of the day, $530 million in positions just like his had been forcibly closed. Bitcoin rallied as much as 8.9% to around $74,000, its highest level in a month. Gold fell 3% on the same day, while BlackRock put $767 million into Bitcoin in a single session. He was not stupid, and he was not an amateur. He was a professional trader with access to better data than most people watching this video will ever have. But despite all of that institutional advantage and experience, he was just watching the wrong screen. The bears were watching the price chart. 5 months of red candles, a 41% decline, negative sentiment, and outflow headlines. That chart was real, those numbers were accurate, and that trend definitely existed. But underneath the chart, something else was being built. a Fed chair nominee who calls Bitcoin a good policeman for monetary policy, a senator legislating banks to offer Bitcoin alongside dollars, 2 federal banking regulators removing permission requirements for crypto, and the United States government quietly accumulating and holding more Bitcoin than any other sovereign nation on Earth. Sustained directional moves in Bitcoin increasingly correspond with ETF data and institutional flow momentum, not speculative leverage. The fundamental character of this market has completely changed. The mechanism that wrecked $530 million in shorts yesterday is not a one-day event. It is the expression of a structural shift that has been assembling in Washington for over a year. They were doing this quietly, legislatively and monetarily, right while the chart was going down and the headlines were calling the cycle over. The $74,000 daily close is the only thing that matters right now. Watch that level, not the noise, not the social media sentiment, and not the price alerts at 2 in the morning. The close above $74,000 is the true signal. Everything else is just the chart. If you're still watching this video right now, your focus and discipline are exactly why you're going to survive this market cycle. You are the 1% doing the actual work. So drop a comment below with the exact words, "I am a diamond," so I know who the real ones are. Hit that subscribe button, leave a like, and stay sharp. I will see you in the next one.